Okay, so let's begin with our assumption sheet for Arvanta India. So assumption sheet acts as a control center of this entire financial forecasting model. As you can see, every yellow cell on the sheet represents an editable business assumption. These assumptions are not isolated numbers. They directly drive the profit and loss statement, the cash flow statement, balance sheet, sensitivity analysis, and financial dashboard. So the purpose of keeping all the inputs in one place is to make the model structured, transparent, and easy to update. So instead of manually changing formulas across multiple worksheets, management can revise a few key assumptions here, and the complete model recalculates automatically. So this is an important financial modeling principle. Inputs should be centralized, calculations should be formula driven, and outputs should be updated dynamically. As you can see, the assumptions are organized in 8 sections. First is reporting entity, second is the scenario manager, third is cost structure and tax, fourth is capital expenditure, that's CapEx schedule. Fifth is PPE and depreciation. Sixth is finance cost. Seventh is opening balance sheet. And eighth is cash flow drivers. Okay, so let's explain each point one by one. So, as you can see, Arvanta India is a fictional mid-sized Indian manufacturing company involved in producing industrial and electrical components. So, from a financial model perspective, defining the company and industry is important because the assumptions must reflect the nature of the business. For example, a manufacturing company normally has significant raw material cost, inventory, trade receivables, trade payables, plants and machineries, capital expenditure, depreciation, and working capital requirements. Now, these financial elements would be very different for a software or a consulting company. Therefore, the company business model determines the structure and assumptions used in the forecast. So, as you can see, there's a base year, which is FY 2025-2026. So, the base year represents the last completed financial year before the forecast begin. It provides a historical starting point for the model. In India, the financial year normally runs from 1st April to 31st March. Therefore, FY 2025-2026 represents the period from 1st April 2025 to 31st March 2026. This model then forecasts the next 3 periods, that's FY 2026-2027, FY 2027-2028, and FY 2028 and 2029. So it is important to separate the historical base year from the forecast period because the model uses actual or assumed historical performances as a foundation for calculating future values. Moving on to base year revenue, that's 100 crores. So the company's base year revenue is 100 crores. Revenue represents the total income generated by Arvanta India from selling its product before deducting costs and expenses. So this 100 crore serves as a starting revenue value for the forecast. So the first forecast year is calculated by applying the selected revenue growth rate to this base revenue. For example, under the base case growth rate of 15%, year 1 revenue is calculated as 100 crores into 1.15, that is 115 crores. Following years then grow from preceding year. That is, choosing 100 crores also makes the model easy to understand because every percentage change can be clearly connected to the resulting revenue. So moving on to scenario manager revenue growth. You see, forecasting always involves uncertainty. Management cannot know future revenue with complete accuracy because performance may be affected by customer demand, economic conditions, competition, capacity, pricing, and regulation. So instead of relying only on one prediction, this model considers three possible outcomes: best case, base case, and worst case. This allows the management to evaluate both expected performance and potential upside or downside. As you can see, the best case revenue growth is 22%. This is optimistic or the upside scenario. It assumes that Arvanta India experiences conditions such as strong customer demand, successful entry into new markets, new customer acquisition, higher production capacity utilization, stronger order book growth, successful product launches, and favorable industry conditions. So, under this scenario, the company's revenue would grow faster than expected. This does not mean the best case is guaranteed. It represents a favorable outcome that management can use for capacity planning and opportunity assessment. Moving on to the base case revenue growth, that is 15%. Now, this assumption of base case revenue growth is 15%. This is most likely planning scenario and represents management's central forecast. So it assumes that Arvanta India continues to grow at a healthy but achievable rate based on existing customer demand, normal market expansion, planned capacity utilization, stable economic condition, and expected sales execution. The base case is generally used for budgeting, board discussions, and lender presentations because it reflects management's most reasonable expectations. Throughout his walkthrough, the base case is selected as an active scenario. The worst case revenue growth is 6%. This is the conservative or the downside scenario. It may represent conditions such as slow market demand, economic weakness, increased competition, customer order delays, regulatory pressure, supply chain disruption, lower utilization of manufacturing capacity, etc. So the company is still assumed to grow, but at a much slower rate. That's it. So this scenario helps management assess financial resilience. It answers an important question. Even if growth slows significantly, can the company remain profitable, generate cash, and meet its financial obligation? Now there's an active scenario. That's a base scenario. So this drop down is one of the most important features of the model. As you can see, this is a drop down, best, base, worst. So when I change, for example, if I change from best to best, you see, all the scenarios changes, right? So I'll just keep it to, you know, base only. But yeah. So as you can see, the model automatically picks the corresponding growth rate and recalculates revenue, COGS, gross profit, EBITDA, EBIT, PBT, PAT, cash flows, retained earnings, closing cash, balance sheet values, and dashboard KPIs. This makes the model dynamic and enables real-time scenario analysis without changing formulas manually. So below the drop-down, as you can see, the model generates a scenario index. The three scenarios are represented numerically. Best is 1, base is 2, worst is 3. Now, because the active selection is based, the scenario index is 2. This is a helper calculation used within the formula logic. It allows Excel to translate the text selected in the drop-down into a numeric position. Okay, so as you can see, the active growth rate is therefore 15%, right? The active growth rate is 15%. And here it is if you can't see it. Okay, so this cell retrieves the growth assumption associated with the selected scenario. The model uses a function such as match and choose. Okay, this choose assumptions and yeah. Okay, I hope you get to understand the formulas also. So this is the match assumption and this is the choose assumption. Okay, so match identifies the position of the selected scenario, while choose returns the relevant growth rate. So conceptually, the formula works like if best is selected, return 22%, if base is selected, return 15%, and if worst is selected, return 6%. So the active growth rate becomes a revenue driver for all these forecast years. Moving on to cost structure and tax. So this section defines a company's major cost and taxation assumptions. See, revenue growth alone doesn't determine profitability. Management must also understand how much revenue is consumed by production cost, operating expenses, and taxes. So COGS as percentage of revenue is 56%. So for Avanta India, COGS includes the direct cost associated with manufacturing and delivering its products such as raw materials, direct labor, manufacturing consumables, production related utilities, factory overheads, packaging, and other direct production cost. Now, COGS is assumed to be 56% of the revenue. This means that every 100 rupees earned in the revenue, approximately 56 is spent directly on producing the goods sold. The remaining 44% represents gross profit. Therefore, gross profit margin is 100% minus 56%, that is 44%. COGS, that is cost of goods sold, is one of the most important assumptions in the manufacturing model because even a small increase can materially reduce profitability. For example, if raw material price rise from COGS, like rice and COGS increase from 56% to 60%, the company loses 4 percentage points of gross margin unless it increases selling price or improve efficiency. So moving on to operating expenses, that is OpEx. So they are assumed to be 18% of the revenue. Now, these are indirect costs required to operate and manage the company, but they are not directly included in manufacturing the product, right? So they may include employee and administrative expenses, sales and marketing, office expenses, information technology, professional fees, research and development, corporate overheads, and distribution administration. So you see, interest and depreciation are excluded because they are presented separately in the P&L. Okay? So for every 100 rupees of revenue, the model assumes approximately 18 rupees of operating expenses. So with a 44% gross margin and 18% OpEx, the resulting EBITDA margin is approximately around 44% minus 18%, that is 26%. This is EBITDA, effective tax rate. So the assumption helps management assess how efficiently company controls its operating cost base. Now, As you can see, the effective tax rate is 25.17%. This represents the estimated corporate tax applied to profit before tax. The rate includes the applicable corporate tax surcharge and cess assumed for the company. The model calculates tax only when profit before tax is positive. So conceptually, tax expense is equal to profit before tax into effective tax rate. Now, the effective tax rate is important because a company's operating performance does not directly equal to profit available to shareholders. Taxes must first be deducted to arrive at profit after tax. In a simplified forecasting model, one effective rate is used across all 3 years for consistency. So I hope you understand. So effective tax rate is different from EBITDA. Yeah. Uh, Sorry for my mistake. I didn't know that. Okay. Um, okay, so I hope you understand COGS, OpEx, and effective tax rate. Moving on to CapEx schedule, that is capital expenditure schedule. So CapEx represents money invested in long-term assets that will support the company over multiple years. So for Arvanta India, this may include new manufacturing machinery, production line expansion, automation equipments, factory improvements, quality control equipments, warehouse infrastructure, technology used in production. CapEx is not treated as an immediate operating expense in the P&L. Instead, it is capitalized on the balance sheet and expensed gradually through depreciation. So CapEx 1 year is 6 crore. This can represent equipment replacement and initial production upgrades. So the investments may be required to replace older machineries, reduce downtime, improve manufacturing quality, support expected revenue growth, and increase operational efficiency. CapEx 2 is 8 crores, which is the highest investment in the forecast period. This reflects a larger capacity expansion initiative. So management may try to invest in an additional production line, factory expansion, new automated machinery, increased warehousing capacity, and higher production capability. So this larger investment should help Arvanta support future sales growth, but it also creates a higher cash outflow and additional depreciation. And the third capex, that is 7 crores, this can represent further automation technology upgrades and efficiently improve following the 2 year expansion. So yeah, efficiency improvements are super important, right? So the 3 year capex plan is therefore not simply increasing mechanically. It reflects a deliberate investment story, that is upgrade in 1 year, like year one upgraded, expansion is year two, and optimization in year three. Moving on to PPE and depreciation. So PPE stands for property, plant, and equipment. So opening gross PPE is 30 crores, as you can see. Okay. So it represents the original cost of company's existing long-term tangible assets at the start of the forecast period before deducting accumulated depreciation. So for Avanta India, PPE may include factory buildings, plant and machinery, production equipments, electrical installations, furniture and fixtures, and computer and manufacturing systems. So the term gross means the value is shown before accumulated depreciation. PP is important because manufacturing companies depend heavily on physical assets to produce goods and generate revenue. And the depreciation rate, as you can see, is 10%. This is under the straight line method or SLM. Depreciation allocates the cost of long term assets over its useful life. Although Purchasing machinery creates a cash outflow at the time of acquisition. The entire amount is not recorded as an expense immediately. Instead, the cost is gradually charged to the P&L over the years in which asset is used. A 10% blended rate roughly implies that relevant asset base is depreciated over an average period of approximately 10 years. In this model, a new capex is depreciated using a half year convention. This means only half of current year's capex is considered for depreciation in the year of addition, based on the assumption that assets are purchased gradually throughout the year rather than all on the first day. So, depreciation affects all three financial statements, reduces EBIT and profit before tax in P&L, reduces the carrying value of PPE on the balance sheet, and it is added black in operating cash flow because it is a non-cash expense. So, yeah, I think we are good with all the explanations till PPE and depreciation. I think we'll continue the finance cost, operating balance sheet, and cash flow drivers in the next video because this video is becoming too long and I don't want you to get bored. I want you to understand. Okay? So I'll stop the video now.